What happens when recent volatility is just a fraction of long-term volatility? Markets tend to wake up. The 10-year yield in focus on today's REKTelligence report. As a friendly reminder, everything in today's show is for informational purposes only. There is no investment advice given. All right, let's get into the show. Hey everyone, welcome. I'm Dave. This is the Edge Report where I quantify specific opportunities in stocks, crypto, commodities, and today, credit. I believe we may look back at this time, spring 2026, as the calm before a major shift in yields. Let's get into it. Before I get to the next chart, which is the focus of today's video, I want to introduce the VOLticipation Indicator. As the name suggests, the idea with this indicator is to anticipate major shifts in volatility. So let's look at how to read it. First of all, readings below 1 indicate that recent volatility is running hotter than long-term volatility. That sounds exciting, but it's not the focus. Readings above 1 indicate that recent volatility is contracting below long-term volatility. That's where things get interesting. When markets get sleepy, when traders forget, often opportunity is right around the corner. So spiking levels are what we're interested in here, as you'll see on the next chart, and indicate that recent vol is seriously low relative to long-term volatility. Traders, crypto is not a wild, unruly market. It's an asset class with 500% more time for price discovery and opportunity. My new course, Crypto Trader's Edge, is now live through Algo Advantage, one of the top quant pods and academies out there. A full systematic framework, backtesting, strategy development, validation, real edges with full code, not hype. Links in the description or head to my Substack at REKTelligence. Now back to the show. Here we've got a very long-term chart of the 10-year Treasury yield, late 1960s, all the way to the present here in 2026. Stepping back, what's the main trend in yields? Well, as many know already, early 80s all the way to the COVID low, basically we are seeing a decline in yields. Of course, it's not a straight line, markets never are. But certainly that was the secular trend, a bear market in yields because it was a bull market in the actual bonds. Those move inversely, of course. Let's look at the VOLticipation signals over the years here. Go to the left-hand side. You can see July 1973, big spike in the indicator. This is when the OPEC embargo was igniting a stagflation surge. The shift in yields did follow that spike. It's a little subtle on this chart. Go to July 1978, however, and you can see this was just really before the Volcker shock therapy, which drove yields all the way up. And you can see it on the chart to 15.68%, really astonishing. Mortgage rates hit over 18.5%, really hard to imagine. Go to April 1989, and we can see a lesser spike in the indicator and a less dramatic response in yields, but yields drifted lower. This was just before the June 1989 rate cut. Recession hit about 14 months later. Go all the way now to this spike in VOLticipation. This was in February 2007. Perhaps you're old enough to remember this time. This is about a year before Bear Stearns started to unravel and the great financial crisis unraveled for the rest of that year and into 2009. Yields certainly declined violently. We see most recently April 2019. This is roughly a year, or actually less than a year, roughly 9 months before the COVID hit. And of course, panic drove rates down to zero. Now, most recently, we are here and we see the largest VOLticipation spike in the whole entire 50-plus year chart is happening right now. You can see very clearly, and I've got the green lines, this wedge shape in yields. And partly this high reading is due to the fact that we're coming off a period where volatility was super high. And so it's easier to get a contraction in the more recent vol driving the indicator higher. Nevertheless, this is a very compelling chart right now. I think whether it's weeks or months, in the not too distant future, at least with a long-term lens, we are going to see a major shift in yields. I'll spend more time quantifying this in the weeks and potentially months to come with some more granular tests with more data points than we have here. While you didn't see it in today's video, if you do any development in TradingView, it's very easy to export those results. And in seconds, you're in Strategy Analyzer, my app, which provides TradingView users advanced analytics, Monte Carlo, significance testing, and more. This drops soon on my website, tradingfromparadise.com. Again, Strategy Analyzer for TradingView Analytics, tradingfromparadise.com. Thanks for watching today's Edge Report. I will be back with Monday's All Markets Report. Until then, trade smart, live well, and cheers from the Caribbean.